Hi there. Let's talk about the days we get it wrong. I'm going to talk about the worst performing position I have in my dividend portfolio. So, about 2 years ago, I took up a position in the AGNC Corporation, which is a REIT. Some of you may be wondering, what on earth were you thinking? For those with a little less experience here, REITs have become incredibly unpopular over the past several years due to COVID and all of the work from home business that led to a pretty significant collapse in commercial real estate, especially around office buildings. I thought that perhaps commercial real estate would bounce back a little faster or there would be some strength in pockets of excellence in certain areas that had a lot of experience here. It turns out I was wrong, and the sentiment or the love of large spaces in the United States, at least as it relates to office buildings or big commercial retail spaces, it really hasn't panned out. It's not favorable. It's definitely a trend in the opposite direction, and a lot of REITs in commercial real estate have taken tough moments. However, AGNC is not new to the game. They've been around for a long time, has very easily met and beaten earnings expectations quarter over quarter, and when I bought it, it paid a stellar dividend. Still does to this day, in fact. But despite all of that, I have, when I log into my brokerage account, a reported 20+% loss on the position, which honestly is not the largest loss I've ever personally experienced, but it ranks pretty high in terms of losses. So what to do? Cut my losses and run, or stay the course? I've tended towards stay the course, and I think that there's a valuable lesson to be brought up in all of this that dives into the mind of the income-focused investor, and that specifically is why I want to have this conversation. Now, when it comes to the loss that I've experienced, you have the loss that can be reported on paper, so to speak, the loss that shows the initial investment that I made, the reinvestments that I have made through dividends, and the value of liquidating the position today. And most reasonable people would say that is the way you would account for loss. But you could also look at this from an out-of-pocket cost personally to me versus the liquidatable value of the position as of right now. And that's nowhere near 20%. In fact, that's under 8.5%. So it's still a loss, and it's still a decent loss, but it's not nearly as significant as the normal accounting would have you believe. The reason these two figures are so different is because I've earned dividends, quite substantial amounts of dividends over the course of the past 2 years because of the dividend paying power of this particular position. Now, there's an argument to be made for the fact that I did earn those dividends, and by virtue of reinvesting those dividends, they have increased my cost basis month over month. And because the trend in terms of share price at AGNC over the past 2 years has been downward, I walk away with a loss, and a pretty significant one, at least when it comes to standard accounting principles. But there is something else that I have acquired over the course of this time beyond just the liquidatable value of the position, and that is shares. Shares of AGNC, because every month I earn a dividend, and every month I take that dividend and I buy more shares in AGNC. In fact, the number of shares that I own right now has increased 27% from the initial number of shares that I purchased about 2 years ago. That then means that the income that I receive from this position has increased just about 20%. More on that in a few minutes. An interesting opportunity to me, though, is the fact that I could start taking the dividends earned from this position and do something else with them. Buy a different position in a different stock. Spend them on whatever I want to myself. I could do that for probably a little while, still sell the position, and still book a loss from all of that, which means the economic value that I could potentially derive from virtue of owning this position over the course of the past 2 years, reinvesting the dividends and letting income grow, gives me an opportunity to spend the money however I see fit, but also leaving the option open to me to ultimately book a loss on having done all this, despite not really having what feels like a loss. Alternatively, having owned this position for the past 2 years, I've recognized a little bit of a trading range it tends to be in. I can tell when it's kind of at the low end of that and when it's starting to get a little high and probably going to turn back around. In the beginning, I used to get very hopeful that it was going to go break into new levels, but that has never happened. Which means realistically, I could, if I wanted to, take money that I contribute to the brokerage account each month and buy up more positions in AGNC when I notice it's at the lower end of that trading range, which may not be all that dumb as far as possible ideas that I could use with the capital. But to date, I've not done that because, quite honestly, I've been a little too preoccupied buying up positions in covered call ETFs and closed-end funds focused on technology and utilities. But the important thing to keep in mind here is the accumulation of shares, the accumulation of income units. And let's talk about that income. So when I first bought the position in AGNC, I was earning about $82 a month in dividend income. Now I'm at a position where I earn $104 a month in dividend income from the position, which is not all that bad. And the bigger lesson to take from all of this is the fact that this asset that I own has fluctuated immensely in price over the course of these past 2 years. But the one thing that it has consistently delivered month over month is income. And that income has increased month over month to me. And that's worth something. It's actually worth a lot in my eyes. And if I think about this in terms of yield to cost, the fact that I have grown income to the degree that I have has brought my yield to cost on this position from about 9% when I originally bought in to 13.37% today. That takes a lot of the sting out of the supposed losses I've incurred on this position. And in fact, the longer share prices in this particular asset remain low, the more shares I can acquire every month that I earn a dividend. So from my perspective, I'm not all that excited about a massive increase in share price at AGNC because there's not a high likelihood dividend payouts are probably going to go higher from here. So if share price is higher, I'm going to buy fewer shares subsequently after that increase comes. I'd much rather sit where we're at and continuously buy more shares and significantly increase income. Now, I will confess something else to you. This position in the dividend portfolio is the smallest one I own, and the income that it produces is the smallest source of income of all of the dividend-producing assets that I have in the dividend portfolio. And given that, it's easy to be cavalier about the losses and say, I've got a lot bigger fish to fry. But there is a lesson that I hope to take from this, and I hope to keep in mind in the future, because I'm fundamentally of the opinion that at some point, something else that I own will lose its luster, so to speak. And when that day comes, I'll think back to these moments. I'll think about AGNC, and I'll remember that the whole point of staying the course was because I want the units, not the liquidatable value. So if there's something that I own that I don't think is going to zero, that I don't think is a mismanaged investment pool, that I do have faith in continuing to pay me a dividend well into the future, there's no reason to sell. There's no reason to panic. We keep the position. We buy more shares because they've gone on sale. The crazy thing about being a dividend investor is you don't really care that much about the day after day after day prices of the assets that you own. You care about the income that they create for you. So when you log into your account, yes, there's a little bit of depression that sets in when you see it's not worth as much as it was yesterday. But when you look at the income produced month over month and that continuously rises, it takes a lot of that sting away. And I do understand that's a bit nuanced for a number of people who have always believed that more value is better because it's more. And there are a lot of investors or a lot of investment advice people out on the internet telling you that that's the name of the game. It's why so many people have fallen in love with indexed investing. And believe me, indexed investing is fine. It even plays a role in my financial life when it comes to retirement preparedness. But the one thing that's very difficult to do with an investment in a regular index fund or index ETF is, for a lot of people, figure out how to take that growth mentality and shift it to an income world when retirement comes. And simply liquidating a little bit of the position month over month over month over month to create income is easy to theorize about. It's very hard to do in practice, especially when prices fluctuate. But if I have a position that pays me a certain amount of income pretty consistently month over month because of the dividends that it creates, and the price value fluctuates, I don't care. Because at the end of the day, that value is not something I had any intentions of selling for cash anyway. So while I may be in a point in my life where I'm still accumulating, I do have clients that I talk to about income strategies. And using dividend sources in their portfolio is one of those things. And one of the great things many of them have learned along the way is Prices are very insignificant when you own a position purely for the dividend that it produces for you. So even if you have a position that shows you a big red loss when you log into your portfolio, if you keep focused on the income that it's producing for you month over month over month, the loss when it comes to what you would get out of the position if you were to sell it really isn't all that significant. And I have advised people who have lost tens of thousands or hundreds of thousands of dollars in dividend-focused positions that have come back. And all the while, they collected basically the same number of dividends month over month over month and didn't skip a beat while the rest of the world probably ran around with its hair on fire. So from my perspective, the fact that there's a big loss for me on paper with AGNC is not a problem. It actually represents a wonderful opportunity to compound growth and income for me. I still have confidence in the REIT moving forward, so I'm not going to get rid of it. And perhaps it's time for me to stop focusing so intently on some of the other dividend-focused things that I have and start adding to that position. We'll see. But buying for dividends is about buying to accumulate shares. We don't care about price at all, at least not in the sense that we're hyper worried about what the value of our portfolio is from the standpoint of liquidating it at any given time, because doing that would be a horrible decision. If I were to sell my position in AGNC, I'd be forfeiting a 13.37% yield to cost asset that I own. That's actually really good. I might even argue better than all of the other positions I own in the dividend portfolio. So if you're going to get into the dividend-focused game, you got to really shift the mindset when it comes to what is kind of traditional investment advice that you'll find on the internet or in magazines. Because a lot of it is going to be hyper focused on liquidatable value, which for most retirees is pretty useless. And for any dividend investor, inconsequential. And if you think I'm wrong, feel free to let me know in the comments. Thanks for sticking around. Here are 2 more videos we think you might enjoy, and we'll see you next time.